I'm Bert Nussbaumer from macrobeat.co.uk. Another very impressive week in terms of volatility, despite some good US data, but we will come to that a little bit later on. Generally, we really still have the same two stories that has really dominated 2019, which obviously is the US-China trade war, as well as the Brexit story. You know, who would have thought that coming towards end of 2019, we still really have both stories still not really being solved. We added a third story, which is a little bit of a concern to me, which is the Hong Kong situation, which obviously the stakes got raised with Trump signing the Hong Kong bill this week, which wasn't really going too well or down too well in China. Global Times has been really writing about this issue and is thinking that we're going to see troubles for phase one trade deal, which I don't really totally agree. I think both Trump as well as Premier Xi, I think both sides do need a trade deal now going into 2020. And as long as I think Mr. Trump is not enacting the Hong Kong bill, as in putting sanctions on individuals in Hong Kong or in China, I don't think the Chinese will really retaliate. In terms of Brexit, the latest YouGov poll, which we've been waiting for, shows a 68-seat majority for the Tories, which obviously helps sterling a little bit and continues to calm nerves in terms of maybe finally having a breakthrough of the deadlock that really held us back all of 2019. But we still have, nearly 2 weeks to go until the election. In terms of what I want to quickly have a look at, I would like to look at the first slide, just have a quick revamp of the US data. So on slide 1, we see Q3 GDP, US GDP, which is a second reading. Again, an improvement. We expected something around 1.9%. We came out at 2.1%. So the US economy is still holding up rather impressively, despite, the global data continue to come out weak. But in terms of average, we still run a good average for 2019. But in terms of looking for how we could proceed, we're going to quickly have a look at the next slide, which is US durable goods. We've seen a jump of durable goods this week, which sort of is nice to see given the weak data in the previous month. So there the trend still seems to be somewhat sluggish, but kind of hanging in. But the big one I think we have to focus going into 2020 is on the third slide, which is the consumption and personal income. Both have obviously peaked sort of second half of 2018 with a rebound as of early 2019. And now things just start to really turn back lower again. In terms of the income side, we see, in the consumption side, we see that we soon back to the early 2019 levels. In terms of personal income, we soon might actually make new lows if the current trend sort of continues. Why is this important? It is important because we have been, talking about the US consumer all 2019, and it is really the US consumer that has been holding up the US economy. And so therefore, this is going to be a big one to watch into going into 2020 to see whether the US economy continues to benefit from the consumer. On the next slide, we have the dollar index. And as I sort of said earlier, we haven't really gone anywhere. We didn't break down in October. We had a retest end of October. We didn't really roll over. Now we've been testing twice this 98.40 area, trying to rally again, which we don't do. So everything is a little bit stuck. And, it's really hard to see where we go from here. Reality is that with the Fed saying, if data is weak, we're going to cut. If the data is strong, we're not going to hike. No surprise that the dollar didn't really benefit from the good data. On the last slide, we have gold. Gold really peaked at the height of the trade war and has really grinded lower ever since. With risk complex staying neutral, with still a trade deal possible, gold is really at risk of sliding further, maybe down to 14.05. This is really it for this week. See you again next week. Bert Nussbaumer, macrobeat.co.uk. Goodbye.